All right, everybody, this is Mike Campos here. This is video number 2 of my maybe 4-part series about home mortgage programs available to home buyers. Today, I'm going to talk about FHA home mortgages. So if you'd like any information about what I talk about today, please feel free to message me below somehow, some way. Let me get notified, and I will send you a PDF document about what we're going to talk about. So today, this program that I'm going to talk about is the FHA home mortgage. It is a home mortgage insured by HUD, Housing and Urban Development. So this, in essence, is the true government loan. This loan allows for a home buyer to purchase 1 to 4 units, residential, and is designed for a low down payment of 3.5% down payment. FHA loans have been around since 1934. They are, in my opinion, one of the easiest home loans to get approved for. It is designed to help a low income, first time home buyer. You can be a second time home buyer and you can finance 1 to 4 units, which is a great thing, because if you're a person who is okay with living in a unit, you could buy a 4 unit, rent out the other units, generate rental income to help you pay for your mortgage. On the application, the other units that you purchase as a whole, so if you're buying a 4 unit, the other 3 units, that rental income goes to your application to help you get your loan approved. So I mean, if hypothetically you're a single guy or a girl and you buy a 2 unit property, you could have a renter helping you pay your mortgage. And then as your income develops, as your equity grows, you can move out, keep the property, move out, and then buy another property. And so you could build your real estate empire this way. So it's a great program for anybody of all types. So here we go. I'm going to jump into the details of this loan program. So 3.5% down payment up to $649,750. So $649,750 divided by 0.965. That means a $673,316 sales price, 3.5% down payment gets you to San Diego's FHA loan limit of $649,750. Now, you could buy a lower sales price property and still put 3.5% down payment. But FHA is a great product to help you get into home ownership. The 3.5% down payment can come from your checking and savings. Your retirement account can be liquidated, or you can borrow against your retirement account for the down payment, or family can gift you the money. Okay? So that's how we get to 3.5% down. The applicants on the loan could be the owner-occupied buyer, and then you can have a co-borrower. Your spouse, your girlfriend, it could be 2 guys, 2 girls, doesn't matter. It could be mom and dad to help co-sign for you to qualify to get this loan. So when everybody's a co-signer, everybody's on the note, everybody's on the deed, and the mortgage is on everybody's credit report. If you purchase a property, if you're married and you want to buy the property by yourself, that is okay too. There are some unique requirements with regards to the non-borrowing spouse, that we have to include the non-borrowing spouse debts into your application. Especially here in California, it's a community property state, so your debts are her debts. Usually we do a 30-year fixed mortgage, so your interest rate and payment is locked in for the 30 years. That way you don't have any changes or surprises on your monthly payment as the economy goes up and down over time. So why does FHA do such a high-risk type loan, 3.5% down, very little equity? They do that because they want to help people get into home ownership. They do this because they charge you 2 different insurance premiums to help back or deliver that loan or insure that loan. So when you borrow the money, FHA charges a 1.8 insurance premium on top of the loan balance. Sorry, it's 1.75. So 1.75% of the loan amount is an insurance premium that's added on to your loan balance. So if you're borrowing $400,000 loan, a 1.75% insurance premium is $7,000. So if you borrow $400,000 at close of escrow, you will owe $407,000. It's a principal and interest payment amortized over 30 years. And then in addition to, on a monthly basis, you're going to pay what's called mortgage insurance premium. It's kind of like PMI for the conventional loans that I talked about last time. So it's not unusual that somebody has to pay an insurance premium on a monthly basis when their equity position in the property is less than 20%. So it's totally normal to do. The thing that's different about the FHA loan is that if you pay down the balance to 20% equity, you still have to pay mortgage insurance premium on a monthly basis. So the mortgage insurance premium on the loan is for the life of the loan, which is kind of an encouraging factor to tell you that this is a stepping stone loan to helping you get to the conventional loan when you build the equity or build your credit scores up to be eligible for a conventional loan. So what that means is that if you borrow money on a conventional loan, you'll have PMI if your equity position is less than 20%. But as you make a monthly mortgage payment, you'll eventually get to 20% equity, and then you can call the bank and just say, hey, remember the rules? And they'll remove PMI from your mortgage payment. So that'll help you save money on a monthly basis without having to refinance the loan into a new loan. Well, with FHA, you have the monthly mortgage insurance premium for the life of the loan. So what the strategy is, what I share with home buyers, is that your qualifications are limited, so we can get you approved for FHA, but this is not your forever loan. Your goal is to build your credit scores up and create additional equity into your property by paying down your balance as fast as you can, and of course property appreciation helps. And then ideally, once a year, I talk to my clients and identify what their possible qualifications may be for a new loan refinance. And our ultimate goal is to refinance our clients out of the FHA loan program and into a conventional loan where the PMI might be cheaper on a monthly basis, or we can remove that PMI MIP altogether because they have 20% equity, thus saving them money on a monthly basis and getting them into a loan that they can keep for as long as their financial plan allows them to. So this FHA loan is a great stepping stone loan to getting you into home ownership, to start helping you build equity in real estate, get a tax write-off on your income taxes for the mortgage interest deduction and your property tax deduction, and help build up your credit scores to make you the ultimate buyer to be eligible for that final loan, which would be the conventional mortgage. Everybody's circumstance is different, so I'm always happy to have an email conversation or a telephone conversation with you. So feel free to reach out anytime. Totally available to help out. It's my job, so I love doing it. Some other unique things about FHA is that they have lower credit history requirements. What that means is that conventional loans typically require 4 years, 6 years from a bankruptcy or foreclosure or a short sale, where FHA only requires 2 years from a bankruptcy and 4 years from a short sale. Did I get that right? 3 years from a short sale, 2 years from a bankruptcy. The FHA loan program also has a different subcategory called the Back to Work program, and that allows for 12 months from a short sale. So if there was an economic situation in the past, they are more forgiving than our conventional or jumbo loan program options. So the FHA loan is more liberal, more forgiving about credit blemishes and credit scores, which segues to the credit score requirement that FHA loans have. Where some of our conventional loans require a 620 to 640 credit score, the FHA loan requires a 600, 620 credit score. So this program is, once again, this program shows that it's easier to get a loan approved with FHA than it is with the other mortgage program options. So what we do as a mortgage company, and I as a loan officer, my job is to collect your income and asset documentation, take your application, and pull your credit report. What we look at is your credit history, your credit score, we look at your income stream, and then we look at your debts on your credit report. And we look at your eligible credit score, which is the middle of your three bureaus. We look at your debt to income ratio, which is how we use, the way we look at that is that we take your pay stubs and W-2s or your tax returns, depending on your job type, to create your gross monthly income. Then we take your credit report and look at your debts on the credit report, plus the new mortgage payment, taxes, insurance, HOA, and so forth, and we create a ratio, percentage, gross monthly income to gross monthly debt. With conventional loans, they lend up to 50% debt to income ratio with high credit scores like 700 or better. With FHA, we can go up to 50% debt to income ratio with a lot lower credit scores like 640, 620 sometimes. So it's a little easier to get approved so you can become a homeowner sooner than later. We look at where your money is located, whether it's in your checking, savings account, your 401k, or if you're receiving gift funds. The source of that money needs to be documented properly in order to get a mortgage. So talk with me early to make sure that we know where your money's at so we can help advise you appropriately. So once I collect your income and asset documentation, I do your debt ratio, I look at your credit report, identify your scores, and I have your application, I would then be in a position to issue to you a pre-approval. The pre-approval letter is what is needed by your realtor in order for them to properly submit a strong offer to a seller and a seller's agent. It is very traditional that a seller's agent vets the buyer and definitely look at the pre-approval letter. I like to call the listing agent the seller's agent and introduce myself and share pertinent information to help them make a decision that you're the best buyer for that seller. So when I issue a pre-approval letter, I will send you an itemization sheet. I don't have one around here. I have an itemization sheet that will itemize every cost associated with buying a house. The cost associated with buying the property and the cost associated with getting the loan. From there, it'll have your total net out of pocket, and it'll also itemize your total monthly mortgage payment, including taxes and insurance and an estimate on HOA. This way you know exactly what type of property you're getting into, what type of sales price, and what that means for you on a monthly basis and out of pocket. I want to make sure that you have all that information up front before you start looking at properties so you can make a good decision for yourself. So if you have any questions about this particular FHA loan program or the conventional loan that I've already talked about, feel free to reach out or message me below. If you have any feedback about this video series, please leave a comment. I appreciate whatever you have to say about it, and be on the lookout for my next video, which will be about VA loans for our active duty military and veteran members. Talk to you real soon.